VC investing is more like dating. The number of chances you take and the faster you move, the probability of you winning is higher. And PE investments are more like marriage, that you have to be very careful, very deliberate. Once you've done it, there is no going back. You can't erase it very quickly from your life.
So, hey guys, welcome to the podcast. So, today we have Pearl from Eximus today along with us. So, you must probably be knowing her. She's a well known name in the VC ecosystem. That is usually a few VCs that are there who have such, branding in terms of VCs. So, welcome, Pearl, for the podcast. And thanks for accepting the invitation and making this. We have been trying, as for the past. So, yeah.
Thank you, Himanshu. It's my pleasure to be here.
I'll if I know a bit about you, how you have been in their journey, and we'll talk about that in the upcoming podcast. But I'll request you to tell you a bit about you and how you started and all of that thing.
Absolutely. So let me take a step back and tell you why I started it. So I come from a tier 4 town in Orissa. Both my parents were micro entrepreneurs. In fact, my grandfather used to own a kirana store, and I would spend a lot of time growing up, as early as when I was 6 or 7, helping him out. Everything from giving orders to collecting cash, counting cash. What I really saw there was a community feel, because we weren't the only store, but there were multiple stores all around, and everybody helped each other. But at the same time, they worked super hard. The place where I was also had a lot of logistics companies and truck drivers. They would start in the morning at 4 a.m. and they would want to buy groceries, buy stuff before going. So people would wake up at 3:30, 4 a.m. to go open the store so they could fulfill those orders. That level of grit and the community to help each other grow was something that was phenomenal. And that really set the tone for what I saw entrepreneurship as, and what I sort of envisioned for my life. But of course, at that point, I didn't know what form or shape it would come in. And I did want to get an education. So sort of ended up moving to Bangalore for some time, and then eventually I moved to the US for business school, where I was at University of Texas at Austin, Macomb School of Business. And that's where I got introduced to the other world, which is the tech world, because Austin was coming up as the new tech hub. Taxes were super low compared to California and the West Coast. You would see like the larger companies as well as the smaller startups starting to create their hub there. Started working with a few of them, consulting on the side, trying to understand. And then eventually during my business school days itself, tied up with a couple friends to work on a trading algorithm. So we were trying to build sentiment analysis for pairs trading, which means that we would go through multiple news articles, reports, and other sort of information that is provided, ingest that into an algorithm to drive what sentiments are being spoken about. So let's say if Apple has come out with their news and they have launched a product, that's a positive sentiment. But we wouldn't just stop at positive sentiment, but we would go down to what level of positivity, and then create certain caught put options to be able to trade on that. We did it for some time, couldn't scale it up because at that point the technology was still far from being developed. Got some firms to even give us commitment to try out the technology. But when it didn't work, we sort of shut it down and started doing it manually, more as a passion. And from there, I moved on to the investment side, where I joined UTIMCO, which is University of Texas Investment Management Company. They had $50 billion that they were investing, $5 billion invested across PVC firms. And that's where I got really exposed to what it is like to build a VC firm and to invest in multiple companies. Super exciting. Got to meet some of the best managing partners out there in the world and really understand and learn from how they were building. Wanted a little bit more pace in life post that. So moved to Merrill Lynch to do mergers and acquisition, and then eventually went to a private equity fund. That private equity fund, we started with buyouts, but over time, I was focusing on early stage emerging market debt products. The kind of transactions that initially I'd started with was 3 billion, 4 billion take privates of conglomerates, seeing what are the cost centers. So for example, if it's a Fortune 500 company, they would often have different either technology assets, infra assets that they're using to carry out day-to-day businesses. So we would try to see if there is a way you could actually generate revenue out of it and not just use it for their own internal purposes, and then carve it out into a new business and relist it. But that whole love for entrepreneurship and the childhood dream of mine sort of pushed me more towards India. So from 2017 onwards itself, I'd started thinking how to move back to India and what to do. In 2018, an opportunity came up when the fund I worked for was looking to set up their office here. So came down to India, spent 6 months, tried to understand the ecosystem and meet with fund managers. Realized that the ecosystem had grown leaps and bounds. From what I had seen back in 2010, there was actually a tech ecosystem that was upcoming. There were mature founders building. So I got super excited, started doing some angel investments. Eventually, the fund we were trying to build in India didn't sort of turn out the way we wanted to. So I moved to London for the next couple years to focus on broader emerging market investments. But in 2020, I moved back to India because the mind was already made. It was just the time of when I can take the plunge. Spent the first year really immersing myself in the ecosystem, doing a few more angel investments, working with the founders we had invested in while setting up Eximius. We launched Eximius finally in March of 2021. And since then have been investing across fintech, health tech, media entertainment, gaming. I'll take a pause there. I'd be happy to talk more about Eximius later. But yes, in short, Eximius is my way of being an entrepreneur while supporting entrepreneurs, which sort of has been the core, I would say, of my existence since I can remember.
Got it. But we'll start in trenches, from the beginning itself. So when you were in schooling, you were at Odisha itself, right?
Yes. So I spent the first few years of my life in Orissa, and then I eventually moved to Bangalore.
Yeah. So in Odisha, you are having a school, so where you have to stay in that school and, you have to study, right?
Yes.
Yeah, right. So what was so special? Because see, currently, frankly saying out me and my sister and all of the, so we have been in schooling where we usually go home and hear across, but when you stay in the schooling, the atmosphere is different. It's kind of a classic gurukul system that we used to have in our past. So how was your experience in that? What do you think that you differentiated in learning in the schooling itself when you were starting up?
Yeah. So I would say, no, in Orissa, I would also go back home because
Okay.
my family lived there. But my school was very different for sure. There was only one school in the town where I was. There were 400 people in one class. I remember until the age of 8, I didn't know how to speak English. I had a few cousins who were in Delhi and they would come back and speak in English. And I felt like, I needed to get out and learn. Otherwise,
Yeah.
I'd be left behind. What was very good is that through rote learning, my memory and ability to ingest a lot of information improved. But in terms of experience, I would say that, it was far from an ideal schooling experience that one would want, right?
Hmm.
Very limited technology. It was basically the entire town, which consisted of people from all walks sort of being there, which really sort of exposes you to work with people from various walks of life and understand them. But I did end up moving to a hostel eventually later in my life. And that is a phenomenal experience because then you understand even deeper how to work with people because you're not going back home, which means that you don't have your safe space or the shelter where you would
Hmm.
be. So you're sort of interacting with people that in classroom that you live with, and that exposes you to a completely different world. It's a lot of fun as well because you would do all sort of mischief around. Being rebellious was the way to go. But at the same time, the people development skills that come by living with people of the same age is quite different.
Yeah, got it. And then you moved out for your, college from Bangalore. Then you move out to Texas in around 2012.
2010.
Yeah, and that was the period where all the markets were down and all of that thing was happening. So, were you seeing that space? Were you experiencing that at that particular moment when you were in college?
Yeah, a little bit of it. quite. I think the 2008 phenomena had a huge overhang until 2009-10. But by the time we started to come about in 11-12, the markets had started picking up. There was massive quantitative easing that had happened, and recovery had already been seen. Even hiring was not as muted. But yes, definitely the economic situation globally was different. If you remember around 2012, the Eurozone was being questioned whether you can have a single currency or not. And that was having an effect on markets globally. So, of course, the markets weren't as good as you had expected, but still much better than 2008 to 10 framework.
And also at that time, like private equity was a less heard name. Currently, अब तो वो थोड़ा mainstream हो गया. But at that particular time, it was very less, and you entered into that private equity space and all of that. So you said you were intrigued by the space. You were taught in the, you must be having certain teaching in the college also, and something in the private equity in that sense.
Yes, so actually, it was very funny how I got introduced to it. I was an economics student in 11th and 12th, and my research paper was around microfinance institutions. So Grameen Bank was a big one that was coming up. Mohammad Yunus from Bangladesh, if you remember, I had done a complete research on it. But of course, I wasn't smart enough to understand the difference between banking and commercial banking, investment banking, and microfinance banking, right? So the first internship that I applied for that didn't require one to have completed like graduation or a certain sort of educational requirement was this company that was letting you do public trading and a little bit of investment banking work. Of course, very little known at that point. It was based out of Noida. There were 3 people sitting in a room, but I applied thinking that I have done my work in microfinance, so any banking related internship that I get is the one that I need to jump onto. But I somehow landed at an investment bank, which was also doing public markets trading, and started learning more about how to invest, what are the ways of valuing a company. And I think that sort of opened up a complete new forum for me, which I sort of explored more in college. So even before PVC, we were into the trading sort of business by building that algorithm. And to a certain extent, yes, in India, this was a very nascent ecosystem, but around that time in the US, it was an upcoming ecosystem. There were already a lot of endowment funds, family offices, PVC that were out there. In fact, Blackstone, KKR are also public funds, and they have gone public around that same time or even before that. So that ecosystem was a lot more developed.
Yeah.
Worked in around 2012, 200 plus VC funds in our portfolio. So there was a mature ecosystem coming up.
Because I remember US may, Yahoo had happened, the dot-com bubble had happened, and all of things. So they are coming up with more funds now, more markets, and all of that was emerging out. But in India, it was like 2012 was a beginning, I guess. So when VC funds emerged, there were around 12 VC funds, just not just VC in generic, 12 total funds, including mutual funds, CAT 312, all of these. So they were just 12, and now they are more than 1,000. That's another scenario.
So it shows that it's not about the point in time, it's a slope. The slope that India has had is phenomenal.
Yeah, exactly.
Today we are competing with a global ecosystem within 10 years.
Exactly. That's 100% true. We'll be talking about that too. I have few things, that I had to, get your perspective on. But prior to that, then you did transactions of like $3 billion, $5 billion in different funds, and while working around that. So what was the key aspects that you took out from there? Because what I felt is when you are involved in certain, suppose you worked in around 3 or 4 companies, and you worked in suppose one company, you got a experience or the view of how the things work out around that. So in the next company, when you moved on, you must be looking around certain different aspects of working on, to learn more, to have more exposure in that cases. So sometimes for me, it's personally like same cheese karke repeatedly kafi time tak, it sounds a bit boring, but thank God startups are not like that. Every time it's something new. So that's a stuff. But how did you tell a bit about those, billions of dollars of transaction that you did, and how you assisted in that.
Yeah. So those transactions were very different from the transactions you do as an early stage fund, right?
Yeah.
I sometimes joke that VC investing is more like dating. The number of chances you take and the faster you move, the probability of you winning is higher. And P investments are more like marriage, that you have to be very careful, very deliberate. Once you've done it, there is no going back. You can't erase it very quickly from your life.
That's a
So
good brain tattoo.
yeah, so the mindset that one has while making PE investments is I cannot have a write-off. Not just
Hmm,
a write-off, I cannot even have less than 1x coming out of a single investment of mine.
hmm,
So I need to very much be sure that this is an investment I need to make.
hmm,
And this investment can at least generate 10% return.
hmm,
It's okay not to have 40% return. It's also okay not to have 15% return.
hmm,
But a minimum of 10%, which is my capital plus hurdle rate,
hmm,
has to be generated. Otherwise, there's a drag.
hmm,
So the downside protection tends to be more of an important aspect to look into as opposed to the upside. The
hmm.
upside is more cream that you generate, but the downside is very, very important to sort of cap.
Yeah.
So that is how we would look at transactions. So once you start looking at every transaction, you have to make sure that the level of diligence that goes into it can take up to 6 months to 1 year as well. Because it
Hmm,
has to be deep, it has to be intense. For us, reconciling every dollar that comes out and knowing where every molecule is moving and what is the growth potential of every molecule, it becomes super important. So what I mean by that is if we are doing a transaction, we would go asset by asset, look at product by product, analyze how they have performed in the past, and what is the growth opportunity or go to market in the next 2 years for them to generate a certain amount of value. Which
hmm,
also means things that don't work out. How do you create a 100-day, 200-day operating plan after you have made an investment to really take this company to the next level? So we wouldn't just make financial investments, but truly add value in terms of generating dollars from there on, which is why it took such a long time. But this was just the product angle of it. Beyond the product angle, there's a capital markets angle as well.
hmm,
Because most of these companies are large, some of these companies are publicly listed, and they also have complicated debt structures. So, for example, one of the companies we were looking at had two classes of shares that were listed in the New York Stock Exchange. Plus, on top of that, they had 7 or 8 different debt products, from term loans to revolving credit lines to your small sort of letter of credit that they would use to be able to trade better. So when you're taking it public, you have to not just look at the underlying asset, but on top of that, how is all of these financing working out?
hmm.
And can you add a better layer of financing to be able to generate value out of it? So it's actually very interesting to marry how growth will finance itself. And if not, what is the other form of financing to generate higher growth out of it?
Yeah.
So today, when you're looking at the burn businesses within, a startup, the last thought that you have is if I'm spending 100 rupees to acquire customer, is my ROI higher than that? ROI not in terms of revenue, but in terms of the final sort of cash flow that is generated.
Hmm,
Because in a large transaction or large business, you are going to be mostly financing it through cash flow generation. Every dollar of capex, every dollar that is spent on growing the business, you're trying to understand, can I generate a 20% on it
hmm.
so that I can drive value and invest?
Exactly. That's 100% true. And I also at starting that point, did you had in your mind like, will you be starting your own fund someday, and kind of that's.
The thought process of starting something of my own was there from the time I was 8. I just had to figure out what really truly excited me. Was it investing or was it operating? I think through the
Hmm,
course of last 10 years, I realized that it was investing. It was always for me looking at strategies, looking at 1,000 feet view, and seeing how things are moving.
Yeah.
I couldn't be one of the pieces in this big asset while you don't have view of the how the other assets are moving. For me, truly what was exciting is that you can see all the different pieces of the jigsaw puzzle and just know how it would fit together, which either comes from you managing a company at a scale or better comes from investing.
Yeah.
And for me, investing was a bigger attraction because of the way I sort of think. It was a no-brainer that eventually this would be the way to sort of pursue entrepreneurship. And why early stage? Because the love for working with early stage founders, seeing the grit, seeing the energy that they bring is just amazing. That ideation process of where there is nothing on the table to actually creating something that becomes a part of people's lives. Where sometimes, after 5 years, 10 years, they cannot go without using that product. That entire journey is just phenomenal.
Yeah, that's true, 100%. Seeing a founder's journey and being a part of it, that's quite amazing stuff that's happened around. But also, like, now coming to the Eximus part, with it. First of all, the name Eximus, I haven't heard this name prior when until unless I heard the name of the fund.
You tell
So
me, do you like it or not?
yeah, I did. That's why it's made me curious.
Yeah.
Their names, they are like, that turns out to become your curiosity, like, hey dude, what's this? Yeah, hey, cheese. So that's kind of a stuff that it made me like. So how did you came up with this? How that's the name?
Yeah. Let me tell you the story. It's a very funny story. So Eximius means excellent in Latin. For us, it was really important to have an ethos of being excellent at what we do and backing people who strive for excellence, which is what overall an Eximius stands for. But how did Eximius come about? Why not excellent, right? Why not excellence? This was at 3 a.m. One of my friends, who's from my previous fund, who's Bulgarian, and she speaks Latin. She writes Latin, and we were sitting and working, and we were discussing how we need to do something else with our life or something outside of it. And I started saying, I'm going to move back to India and start a fund. And she's like, great. What are you going to name it? And I'm like, something with excellence, something with excellent. Can you tell me a funny name? And then she's like, why don't you use Latin? And she suggested Eximius. And that day we sort of coined it that, okay, when we start our fund or when I start my fund, it'll be called Eximius. Little did we know that we're going to ever do anything of this sort. I had no plans of moving back at that point. We were just at 3 a.m. trying to sort of have some banter. But when I moved back, that whole episode sort of stuck with me. And because the ethos was still something that we aligned with, it just made natural sense to keep it as Eximius.
That was kind of a aha moment, हाँ ये रख सकते हैं, that's वो जो मजा आता है उसमें, क्योंकि the same happened with me when I was doing the previous started up. So we were doing a startup known as Letter with my co-founder, and we got into Thiel Fellowship second round, but still we were not able to do anything. So usme we were not able to get the tech people and we were not the tech guys. So we were discussing, यार ये problem आती है, वो problem आती है. So I said, यही start करते हैं. Let's solve this. And while thinking of the name, we were saying, यार क्या करें अब, startup तो कर दिया है, and we thought startup. It started up. We started up. So name that started up. That's the thing. So
That's all. Yeah.
kind of that aha moment that stuck in. Yeah, that's true. And also your investments that you have been doing in Eximus, has been phenomenal. Like we were talking about previously also, like one of them is, Hood, that is the part of, then there's Fleet, then also now you have expanded into more. And if we talk about gaming, there is, XO that is there. So how do you, specifically recognize these founders, to tap in, and how do you get them? First of all, that's the thing.
Right. So for us, we use all different mechanisms to be able to get founders. I mean, today, I believe that in the early stage, sourcing is the biggest moat that you can create. You can't invest in something that you can't see. So seeing as much as possible is very important. So what we try to do is that we have all hands on the deck when it comes to sourcing. Everybody from their own network, through creation of new network and through top-down content channel, tries to interact with as many founders as possible. But at the same time, what's important for us is that we limit ourselves to a few sectors where we have deep thesis and where we can add value to the founders when we are speaking. Because let's say today DevOps is not really an area of ours. Even if we were to speak to a founder, neither will we understand nor will we be able to add value to him or her, which is very, very critical. That if somebody comes in at early stage, you need to be able to bounce off ideas with them. So our first thing is that we create deep internal thesis in areas that we're interested in. We spend days doing so. Then we have all hands trying to source it, source different deals, speak to founders and understand founders' journey and see where we click. It's a lot about chemistry as well. And at the same time, understand that the problem statements that we've identified, how are these founders really able to build on it? Do they peel the onion in a way, right? Go deeper to understand whether they have the right domain expertise. If not, how are they going to hire for it? What is their thought process in terms of the TG that they will go? How much work have they done? Have they done cohort analysis to understand what are the different TGs to work with? And then go deeper into it. The kind of product that they want to build. Once we have clarity on how a founder is thinking of a white space or a product that we've invested in, then we sort of move forward with it. So I'll give you an example, right? For example, we have invested in a company called Bima Coverage, which is building insurance distribution for business liability products. For a very long time, based on my personal experience and interacting with people, I knew that SME business liability insurance was a pain to buy. It takes 2 to 3 days for anyone to call for quotes. Once quotes have come in, it takes another 10, 12 days to evaluate it because there are multiple different, business liability insurance that you can buy, DNO, PNC, and so on and so forth.
Yes.
And getting a combined quote takes a very long time. Then you compare it. After you've compared it, you need to have an assessor who will physically visit, evaluate, and then finally give you an insurance. When they give you an insurance as well, you're not sure how well you're insured because a certain fire beyond a level is not insured, for example. And you weren't aware of it before. So the entire process is so broken that it was known to us that something has to come up in that. We just had to identify. So when we went about and created this thesis based on our personal experience and then desk work to understand how large is the market, is there a viable business model that can be built? Then we started meeting with and identifying founders that were building in that space. I came across Tejas, even though the product wasn't ready necessarily, we knew that he understands this space in and out. Even if the product today is not up to mark, because of his understanding of the consumer segment A and his understanding of the market, there is no way he can't build this product, which was very important to us. So here there are 3 things that's clicking. 1, we knew the problem statement well. 2, we did our homework to make sure that it wasn't just the problem statement, but a viable business model that can be built. And 3, when we met the right founder, we sort of understood his or her thought process to be able to validate whether it matches what we had thought about the business or not. And if it doesn't match, then does he have deeper insights? When all 3 of those clicked, we went ahead and invested. It really allows us to invest in the pre-seed stage. Pre-seed stage, I believe, is a unique DNA of its own.
Yeah.
Being able to invest in a founder when you can't see anything, but there is just a paper-thin idea and a founder who has started 2 months ago, it's not easy. It's not a Series A investment where you can see the product being developed, customer traction coming in, and have certain data which is clear, crystal clear out there for you to take a decision. You have to invest multiple times in pre-seed and have to learn from your experience to really build that DNA because it's more of an art than a science.
Yeah, that's true. Because what I have also heard from a lot of angels and funds that, pre-seed is kind of a different, even seed. They both are kind of a different thing. as comparison to other, where you for others you look out for how the month on month growth is, the other metrics, the KPIs are performing. But in this stages, you generally go out and look for the people and guessing. It's kind of guessing, or you can say the instinct that you get that this person would be able to do that or not. That's kind of come through, yeah,
Let me
experience.
let me take a step back, and I would like to double click on this word guessing,
Yeah,
because when people who are not investing in the pre-seed stage
yeah,
invest, they are guessing. It is a DNA of its own. It
yeah.
is sort of like saying that, how do you identify the right student entrepreneur?
Hmm.
Their student entrepreneurs haven't taken off. Well,
Yeah,
that's because funds haven't built a thesis for what a student entrepreneur should look like.
yeah.
Similarly, funds haven't built a thesis for what a pre-seed stage founder should look like. And
So,
hence, for them, it is playing blind or guessing or going with instinct. What we have done is we've built a deep thesis in terms of what
hmm.
a founder's journey at a pre-seed is like. And when we see a founder, where should we benchmark them compared to the rest of the pool that we have? Because if you're
Oh,
seeing 300 plus, we get 300 deals in a month. If you're seeing 300 plus, pre-seed stage founder, very quickly you develop an art for understanding who are the top 5% of the pre-seed stage
yeah,
investors, the pre-seed stage founders. And from there, a founder's journey is like a slope. It sort of keeps increasing. So where they are in the slope there has to be a deep understanding.
hmm.
You can't expect a pre-seed stage founder to look like a Series B founder. If you speak to a Series B founder, um, regardless of where they are in the benchmark, they will always sound better than a pre-seed stage founder.
Yeah, exactly.
So how do you differentiate among the various ones is where you need to sort of have that the stage focus and
Hmm.
stage dedication.
That's true. That's true. That's, yeah, got it. So yeah, coming on to the few other side of flipping other side of the things, you have been seeing like in India, a lot of companies getting public, and specifically to startups, and they're getting losses, and all that thing is moving on. And I was doing a deep analysis on that, but we'll take that post your views on that. So how do you see the people usually कि ये company loss कर रही है भाई, क्यों आ रही है public, and all of that thing is happening around. So how do you see that stuff?
Yeah. So to me, it also depends on the maturity of the markets. See, ultimately, markets have different kind of companies. You have blue chip stocks that are sort of yield
Yeah,
generating. They generate a consistent dividend yield. Their
yeah.
dividends will go up 15 to 20% per year, and then you continue to make money.
Hmm.
You also have SME stocks, which are high risk but profitable. And then you have high growth stocks like startups that will continue to generate losses for a very long time, but they are creating true innovation.
Yeah.
To me, I feel where there is a problem is if there are startups that are not leading to proper innovation. Because if
Hmm.
they're not creating impact on ground, for them to sustain in the long run will not happen. So retail investors are bound to lose a lot of money.
Yeah.
But if there is a startup that has become part and parcel of people's lives, I'll take Zomato for an example, right? Today, can you imagine your life without Zomato? I
Hmm.
think every single person who said that I don't need to order in, I have Chotu who can go pick it up, or we eat at home most of the time, is today probably using Zomato at least once a week.
Yeah.
With urban mobilization, Zomato has increased, the consumption of Zomato has increased even more. So Zomato as a product is not going away anywhere.
Hmm.
It will stay where it is. People are, and hence that's an innovation, right? Because people are seeing that as a need as opposed to just a want. Now, how does the economics work out is something that can change over time. And hence, sometimes to create a need and change behavior, you need to incentivize people, which leads to losses. But
Hmm.
over time, when that need becomes deeper and deeper, you can start charging people more. There was a
Hmm.
time when we didn't need high-end fashion product,
Yeah.
but over the last 50 years the need for high-end fashion product with evolution of society has changed, and
Yeah.
hence they have become a profitable business today. So similarly, I believe that high growth tech stocks that are working on next gen moonshot innovation have to first incentivize people, which means that it'll lead to losses, but it'll make money in the long run. So for me, that is its core importance. And that's what retail investors should look at. That can I see this affecting my life and affecting people around me's life for the long term?
Yeah, got it. Because I compared this to the US economy part to understand how they have worked when the startups got listed. So I got to know like when Facebook listed, they turned to be profitable. When Microsoft listed, they were profitable. But what happened when Amazon was listed in 1997, around 25th March? So they were not profitable at that particular time. And even though it took them 14 years post listing to become profitable. So, and now the profits are really massive. So that was the thing, when I was comparing the both US and Indian economy, I discovered out that uh, it's not about uh, it's not whether they are successful or not. It's about when they will be successful. It's not a yes or no question. It's a timing question.
Exactly. Exactly. That is my point. That if you can see them being successful, them being adding value, then it should be a company that survives. If it's a company where it can survive decades and generations, then it's a business where one should invest. It's a business that should list itself.
Because I usually ask a lot of people this question, what do you think, who will succeed? Startups like Google, who are fragmented into a same sector as a tech a lot, or conglomerates like Reliance or Tata, or who are spread across. So, and the people have a blend towards us, both of the stuff. But yeah, prior talking about that, I would like to ask the same question to you. How do you see it? Do you see startups like Google who are spread across the same sector in the tech field, or do we see conglomerates like Google in the future, like next 30 years, next 50 years? How do you see that stuff?
Yeah. So it's a function of market and the depth of the market, I would say.
Yeah.
If you see Google, there can be a Google that can be created for India as well. And
Yeah.
after 5 years, it will be very successful, regardless of how diversified they are, because the Indian markets and the tech adoption of Indian markets would have grown to that level. Today, because the Indian markets haven't evolved to that extent, we haven't seen a lot of blue chip companies come up in the tech space. Google has also taken decades to be built. So if you see the next couple decades, there could be multiple of those companies come. Having said that, the US also has large conglomerates, right? With the Coke Group, which is a large conglomerate. You see, the Dow Chemical, large conglomerate. So there have been sort of other industrial companies that has been prevalent in the market for a very long time. Similarly, in India also, you will see a shift. You are seeing the Reliance and the Tatas of the world, which are older companies that have survived for a very long time, entering into new areas. And because the markets are not deep, it makes sense for these companies to be able to have a different arm and still be able to survive, or have a different arm within tech. But over time, you will start seeing these individual verticals itself become deeper. It's similar to like what you see in Korea. Today, Samsung is the largest component of the Korean market capitalization. You see Samsung being entering into all different forms, of course, electronic components, but from beyond that, they've also done, your hardware products and more of sort of software products now, investing in other asset classes, tech companies. But that's because they are one of the largest company for a particular country. So you'll always see smaller economies where concentration of wealth initially happens with large conglomerates, but with deepening and maturity, that sort of spreads across different verticals.
That's true. That's true. And even like while I was doing the same, so there's been multiple thoughts that I have asked. I asked this question from Ravindra Baiju. I asked this question from Anand Chandrasekhar. So I have been asking this question. So most of them had a similar kind of view, like, the startups are still early, the conglomerates are late, or, the wealth, the thing that is happening around, the conglomerates are also stepping into this. And I also saw a glimpse of that in the recent times when I was reading a bit more about Amazon. An article was there, like, I don't exactly remember the timeline, but let's fictitiously consider it was 2015. So an article published that Amazon is into every segment or every sector except real estate. And the next year an article came and that said that Amazon entered into real estate. So
Yes.
yeah, that's happening around.
Yeah. Of course, as a company sort of survives decades and years, they are bound to diversify. And if they are generating value in one segment, to be able to sort of keep up with that growth, they have to find other high growth areas. So it just becomes inevitable that they sort of enter into multiple different segments.
True. And there is one more guy in this ecosystem, in the VC specifically, who holds a major share of the world's VC ecosystem. So the world's VC ecosystem is around $146 billion. He holds $100 billion. Rest 28 to $30 billion is held by A16Z, and the rest is spread across. So what's your viewpoint on Masayoshi Son, that SoftBank, because he chases the point of singularity? And do you also believe that at a point of singularity would be there, where machinery and all of that stuff will be happening around? So how do you see that?
See, at the end of the day, we all know that there is increased penetration of technology in our decision making.
Yeah.
That is bound to happen. With Chat GPT is the big buzzword that is coming up. With Chat GPT, you're realizing that we are moving closer and closer to how humans make decisions and how humans behave in the technological world. AI has evolved in the last 10 years the way it had never evolved back in the day. So 20 years, 30 years down the line, will you start seeing a lot of the manual decision making, a lot of the type 2 decision making, if you will, right? Decision making, those are not critical enough to alter a person's life.
Yeah.
Or, the little sort of things that you think about every single day, that if you didn't have to think, then you had the bandwidth to actually go deeper. Can those be outsourced to technology? Can those be outsourced to robots? And will robots come and start taking it up? 110%. Just taking a very simple example of an SME in India. Back in the day, you had somebody standing and monitoring the production process. Today, with AI entering into that, you are getting SMS alerts when your production process is getting altered.
Yeah.
Right? That's a very, very basic example of how you've replaced humans. You're not necessarily seeing a typical sort of robot, moving around and speaking in a robotic voice, but it's still a robot when it sort of gives you a signal or an SMS, right?
Yeah.
So yes, it will move in that direction. But having said that, for us as an investment firm, it's really important to look at the horizon for the next 10 years perspective. Because a fund's life cycle is 5 to 10 years.
Yeah.
Deploying capital for the next 2 years and waiting for it to show results in the next 3 years or 4 years. So despite what the timing of advanced technology would be, what you want to focus on is what are the trends I see for the next 2 to 3 years, which is where how we make decisions. We look at currently where we stand in the geography that we are investing in. Where is it? Where do we see it heading in the next 3 years? And what are the solutions that are required for those next 3 years? If we had more patient capital, we would definitely want to take bet for 5 years, 10 years. But with a traditional fund and the way it works, you sort of focus on the shorter term.
Got it. And there is one more thing that I have seen in that VC ecosystem, that because it's not kind of a mainstream, but it has been मतलब पूरा mainstream नहीं हुआ, but still it has gone a higher side in that stuff. So there had been kind of, who I say, traders in this ecosystem, because investing in startups is a kind of patience game. But they're kind of traders who have entered into this, who are just, deploying a lot of capital, then just saying like, I have to take out that capital, raise another, and all of that. So how do you see that part also, having these spaces, and how does they affect the ecosystem in that kind?
Yeah. See, there will always be fair weather investors that come in a bull cycle and they vanish in a bear cycle.
Yeah.
Going back, you would have always seen this happen. Because when an asset class becomes hot and you're starting to see good yields, there will be people who would want to leverage that short term. But short term doesn't have to be as short term as a cycle. Short term means that, when I refer to we looking at trends for the short term, I meant more around the fact that we are looking at trends that will play out in the next 3 to 4 years, which is timing the market. That if I'm building a solution today and I have runway for the next 6 months, can I get somebody to adopt this solution in the next 6 months?
Yeah.
Because even if that solution needs to be adopted in the next seventh month, I will not have the runway to survive the seventh month. I will only have to survive 6 months. So it's important that you really time your solution as per what is required in the market. And you start working on creating a need or creating a distribution from day one so that you can validate it. For us, that is what is a short term, 3 to 5 year horizon. But in VC as an asset class itself requires you to be there for 3 to 5 years at least, or 5 to 6. So if you start seeing either corporate venture funds or fair weather investors coming through syndicates, wanting to invest and get out quickly, you know that you're in a cycle.
Yeah.
So you stay away from it and you move towards a different direction, because sophisticated investors in this market will know that you need to stick around. You need to see a couple cycles go through. Companies are not made overnight. Companies take time to be made. Behaviors take time to be altered.
Yeah.
So I don't see that these guys will necessarily be able to change the ecosystem. They will come, they will either make money or lose money and then leave. And folks that have the stomach to be able to survive in the long run are the ones who are going to stay, and they are the ones who are going to make the real difference in this market, real difference in ecosystem. When have you seen really innovative solution being funded or developed by somebody who's been a short-term investor?
Yeah, it's obviously it's not. Yeah.
Exactly.
Got it. So yeah, it was fun having a chat. Finally, So yeah, we talked a couple of things. So I was reading through these things, about SoftBank, about these economy comparison, and got a bit more clarity in that aspects. Yeah.
Yeah, I believe India is positioned in one of the most favorable ways today. I mean, just look at it globally. We have 800 million people who have access to smartphone. We can have 400 more million people, having access to smartphone. That is larger than the population of Europe.
Exactly.
Triple the population of US. We are English speaking country, which means that products developed in India can be taken worldwide. Products developed worldwide can influence India, as opposed to other economies where language is a big barrier.
Yeah.
And in a world where every single country is battling recession, we are nowhere close to recession. We have lower inflation than developed country, higher growth than developed country.
Exactly.
And this looks like it's going to continue for the next 2 to 3 years at least. So this is the best time to be in India and just stay put in India.
Yeah, that's 100% true. The growth and the opportunities that are coming up in India are truly global, not just limited to the nation right now.
Absolutely. I mean, if you see, we have 3 trillion of payments flowing through, and we're expected to double it in the next 2 years. Can you imagine? It took us 75 years to get to 3 trillion of payments. In the next 2 years, we will have the same amount being created.
Yeah.
So much wealth generation.
That's
the consumption story that will evolve from there just be outstanding.
That's true. So yeah, we'll since we'll mark the end of the podcast over here, and I'll just So yeah, thank you for being on the podcast and having this fun chat.
No, absolutely. I'm super excited to be chatting with you more. The thoughts that you brought out were phenomenal. I'm glad that you're sort of reading about the innovation that's coming about.